Hey, welcome to Mackey's Retail Roundup. I, of course, am Mackey. Let's just cut to the news. We're ending up earnings week. We start with Walmart, we end with Lulu. We'll get to them later. But we had three big companies that I was watching. Yes, I know the Dollar Tree, Dollar General, they're crushing. Congratulations to the dollar. But we'd already heard from Costco and Walmart, and we know that end of the consumer world is doing just fine. The three I'm watching this week: Signet, Victoria's Secret, and Lulu. Signet reported this morning they actually were pretty freaking good. If you get right down to it, they comped positively. Now, that it is unequivocally good for the consumer. It just, you're doing K Jewelers, you've got a different jeweler basically on every level of the mall, from high end to the lowest end. That's Signet's core customer. Listen, Signet's not comping positive. The consumer is a disaster. Is that enough for this stock? I don't know. They had a 10% gain and they're kind of been staggering a little bit all day. It's not an Abercrombie and Fitch reversal, but these were really, really good numbers given the environment at hand. And the important thing about Signet is they were short, not because they necessarily had so much China direct exposure. This was a play on basically the whole world going to hell in a handbasket. That didn't happen. It's also big news from Signet because these guys have been a classic disaster. This is a 10-year chart. This was maybe one of my favorite shorts of all time. People like to say, oh, I don't care, prices just move up or down. Let me tell you, as someone who's a fan of narrative, I like good guys and bad guys in all my stories. Signet was a really kind of a group of bad guy companies. There's some like, Diamond Insurance and just strange things to people that can't necessarily afford them. That was their MO years ago. I don't need to be sued because I'm talking about people who no longer exist. Anyway, it was a fantastic short for years. They've been turning it around. And what you've seen over the last 4 years or so is this company just consolidating, just digesting the books, going through kind of better teams, new management. It was a terrific quarter. They didn't die. I'm a huge fan of companies not dying. In terms of the stock running away from you, probably not going to happen. Let's be realistic, but it's a good company and they've taken it to the next level. It's also got a bid underneath. They're a cash flow positive company. And so as we established with Foot Locker and Dick's, there's going to be somebody to take them over. You could cut about half of these stores. Maybe malls don't need 4 jewelers anymore just because nobody buys diamond rings. Food for thought. Victoria's Secrets came out. They were supposed to be reporting on Thursday. I was kind of excited to talk about it. They've been a crazy few. Obviously, this is the last year. The company pulled like about a 5-bagger, gave every single penny of it back, all the way down. It's trading at 9 times earnings. They sneakily pre-announced today, and they beat. Hey, go figure. For a stock that's down from $49 to $14 in the last 6 months. Seems like a beat would have been good, but unfortunately they pre-announced and then they delayed the details, and the devil is absolutely going to be in the details. This, in contrast to Signet, and yes, my friends, there is a little bit of a theme winding through here. We've got one company with really no real China exposure. Victoria's Secrets, on the other hand, well, they get a lot of their underlying things from the Chinese economy, and if not them, Vietnam. It's really just a potpourri of companies with enormous tariffs on them. CNBC's got great stuff on what the tariffs mean for prices because they're trying to take a consumer angle. What the tariffs really impact is cost of goods sold, because if you're Victoria's Secret, they were on the happy side of cash flow positive this quarter, but it's a really kind of fragile business. And if you double their cost of goods sold, or in a worst case scenario, you go up to 150% type of tariffs, it's kind of an embargo for them. They're not going to be able to stay in stock. That's why the company's only getting about a $2 pop. But again, the consumer's not showing up that horribly. These earnings were surprised to the upside by about 4 or 5 cents. That's terrific. That's good news. You end up, though, with stocks that are not breaking out. They're not breaking high. Victoria's Secret's going to wait for the call, and it's all going to be about tariff controls for them because that's not going away, and that's really the biggest side. You can see in the XRT added up, these companies really represent what's going on in retail world right now. You can see this has been a crazy ride to nowhere. Now, the bears look at this chart and they just see us pure topping. If you look over on the right-hand side, that just here's we've got a 90-day delay moment, gap higher, the liberation from Liberation Day, which caused us to gap lower. We've been basing since then. That looks pretty good. to bulls, to bears. They say we're going to fill that gap and we're rolling over. We're forming a base. Both sides, to be honest, have a little bit of a point. That, you know, gets to the state of consumer stocks. We're ending earnings. They were really pretty bullish. You know, people can complain. They can say the hits are just going to keep coming. But Urban Outfitters was amazing. On had the best report I've seen. It was reminiscent of Lulu, who we're just about to talk about. Kind of Lulu at their peak were turning numbers that looked like a misprint. Just better than anything you're ever going to see. Now they don't do that so much anymore. OnCloud came up with that. That was fantastic. Even the companies that pulled in terrible numbers, companies that have been really suffering, Target springs to mind. We've got a whole different piece coming up in the next few days on reactions to the Barron's "we can fix Target" thing. I'm not so sure they're going to be able to. But for the most part, even Target is not lower by much. Abercrombie had disappointing. Gap was disappointing. Companies that didn't have their act together on the tariffs got done, but for the most part, earnings were bad, which is bullish. You know, and the stocks, frankly, after what we saw this weekend, when all the little minions from the POTUS office came out and they said that the tariffs are never going away, we're never getting rid of them, we're never backing off. Taco this, USOBs. That didn't seem bullish for consumer stocks, but we're having an okay week. That's pretty good. The bearish thing. The delays are kind of priced in. At this point, the delay, we're getting about 40 something days into the delay on when you can ship the clothing. We had another delay of the delays that went on this morning in specific semiconductor related goods. It didn't spike the market. We're priced in. We need a deal. We super need a deal. Make Finland sign something. Tell Greenland we won't take you over. We won't try to buy you for a few weeks if you just sign a trade deal for whale blubber or something. We need something specific. And with the delays being priced in, that means that it's all going to come down to an Asian production center profit that if without a deal, the profits are just going to be crushed. And as we've talked so many times in the past, the worst kind of catalyst, the worst terrible thing out there is a big, huge, ambiguous number. And we were able to escape that a little bit when the earnings were coming in. But now that they're over, the companies aren't going to talk anymore. Once the companies aren't talking, then you just have Bessert and Howard Lutkin, and they're not quite going to say the same bullish things. So we're going to need a deal from the bears' perspective. Once you run out of the good news, all you got left is bad. The 90 days that everyone was supposed to celebrate, we saw that nice gap higher. Remember this little gap higher? All of a sudden, you start counting there from there to 90 days. It's just going to become a countdown clock of doom. It's Dick Clark in hell. But until then, like I said, we've got Lululemon. Who's not excited for Lululemon? How could you possibly not be? I guess there's plenty of people that couldn't be. Most of the people I know aren't. But let me tell you, I am. A lot of reasons for that, though. This is kind of a big story. It's been a favorite stock of mine for a long time. It's at a critical technical point where they've gone sort of as far as they can without just coming up with an actual solution to the company problems. Begging the question, there are various stages of turnaround. There's someone like Kohl's or Saks, RIP, who just the tariff, the fact that it costs anything extra puts a company straight out of business. There's other companies like Lulu that was in the middle of a turnaround, and it's less that they're going to run into liquidity problems because this balance sheet is really solid. Again, Lulu went on one hell of a run. It's for years. So it's not whether they can stay in business. It's whether they're going to get enough traffic flow to allow them to get some traction in terms of turning around the store base. If you look at the chart there, you can see where the downward dog resistance, that's it from the Liberation Day lows. Or Liberation Day break, excuse me. And that's going to prove to be a pretty sturdy resistance level when we get into the numbers. It matters because Lulu, after being just an unbelievable stallion, this stock is almost shockingly down like 4.5% over the last 5 years. It's up 5% today. So market works in funny ways. We're getting back to even, but we're at levels that we saw in 2020. Now, I was long this stock from 2013. And you can Google me whining about Lulu pants and how they need to go into men's pants because men's pants suck and people don't want to wear wool all the time, which I was right. But it's we need Lulu to kind of break out of this funk that they've been in. They started the sell-off in March of 2024. Cal McDonald, CEO, the very well-regarded CEO of Lululemon, said he saw weakness in the Americas. And man, the stock has been smoking, hurling death pretty much ever since. They need a breakup. They need this really bad. Now, the question to watch there, the three things they're going to need to see are going to be growth in America. If they can get North American growth, that'd be great. They were carried by 23% growth in China last quarter. The expense side of things, it should be under control. Lulu should have a pretty decent handle on what's going on with the tariffs, and they need some fashion traction. It's the last big one, folks. This has been a hugely eventful earnings season. I'm going to break them all down for you next week. But the thing to know is Lulu's priced for about a 12% move. I don't know if they see it. I don't know if they're going to be good enough to get it. I don't know that the downside risk. If I'm going to force to bet, I would say in light of if Victoria's Secrets can get moderate traffic, which they did, despite the fact that shortly after the quarter ended, their website crashed. So maybe things aren't operationally fantastic there. If Gap can report decent numbers, which they did, despite the stock getting shot in the face for different reasons, but we should see decent traffic from Lulu. Lulu should not be a disaster, but they need some traction. They're starting to lose a little bit of their mojo. That makes sense. No one's young forever, but they got to do better than they have. Now, can they break out? Well, that's where we are in the market right now. You see, and that's where we ended up with. That's kind of, it all brings us back to basically the bullish versus bearish state of the market graph. It's really hard to argue that consumer stocks are worth more now than they were before all this trade war tariff nonsense started. Earnings are for sure going to get hit. It's about the cost of goods sold. It's not about whether or not they can pass on to consumers, because really you're not going to at certain levels. I mean, it amounts to about a 40% increase in your cost of goods sold. The margin is going to compress somehow. But the question is whether or not we can get a deal that the companies can live with so we can make that adjustment. In that case, you can maybe make an argument for paying higher multiples for some of these names, or the earnings are just going to kind of collapse. But for now, anyway, the consumer's hanging in there just fine. It's bullish for the stocks. They continue to work higher. It still is just a binary type of world where Walmart and Costco's numbers last week were ridiculous. People don't want to pay high multiples for Walmart and Costco, and then you realize that they're just operating in a different world than the Targets and the Kohl's and the planet. But the specialty stores have been okay. Urban was great. Lululemon's going to wrap up the show. We've laughed a little. We've cried a little. Walmart kind of taught us what it is to be Walmart. Now let's see what Lulu can do. See if they can stand up for Canada, come in like Canadian goose and really stick it to the man by having huge numbers on Thursday. I'm Macke. Hey, drop me a note. Let me know what you think. Let me know what questions you have about the consumer coming in. Who was your favorite earnings report? For me, again, it was On Clock. They were Swiss. They were remarkable. They were beautiful. We have Restoration Hardware, Gary Friedman, later this week. Be sure to cover that. That's kind of the acid trip version of Williams-Sonoma for you people not in the know. It's a call worth listening to. I hope this is worth listening to. You give me a shout out there. Let me know what you think, and we'll talk to you soon. I'm Macke. This is your Retail Roundup.